In the world of investing, one name stands tall: Warren Buffett. But how did he rise to such prominence? Was it a complex algorithm, a secret tip, or pure luck? Here at Market Matters Media, we're diving into the heart of his techniques. Buffett launched his investment journey at the tender age of 25. By setting up the Buffett Partnership, he displayed a prowess most only could dream of, amassing an impressive average return of 29.5% over its operational years from 1957 to 1969. Its secret? Investing isn't reserved for geniuses or those with complex strategies. As Buffett puts it, rationality is the cornerstone. It's not about a high IQ but about sticking to a game plan, even when the going gets tough. Let's break down the 7 pivotal rules Warren Buffett swears by. 1. The bond between business and stock. Drawing inspiration from the influential book The Intelligent Investor by his mentor Benjamin Graham, Buffett realized the golden truth. Owning a stock is equivalent to owning a piece of a business. If a business flourishes, so will its stock. So aim for those companies that have strong foundations, a clear vision, and are loved by their consumers. While Buffett highlights the bond between a business and its stock, it's equally vital to understand the dynamics driving that business. What's a company's competitive edge? Does it have a moat, a unique advantage that sets it apart from competitors? For example, Apple's brand loyalty is a significant moat, ensuring a consistent customer base. Additionally, the longevity of a company's success is often tied to its ability to adapt to changing market conditions and innovate. So before diving into any investment, it's essential to gauge not only its present standing, but also its potential to thrive in the future. 2. Filter out the noise. In an era of information overload, Buffett's advice is to sidestep the majority of it. Channels, websites, even fellow YouTubers often overhype information to draw views. According to Buffett, only about 5% of this is crucial. So be selective and focus on what truly matters. Beyond individual businesses, Buffett also keeps an eye on the broader economic landscape. This includes understanding macroeconomic factors such as internet rates, geopolitical developments, and global market trends. Being well-versed in these areas can offer valuable context when assessing potential investments. Moreover, in the cacophony of today's digital age, maintaining discipline and patience is paramount. Warren Buffett's long-term investment philosophy stems from his ability to resist the allure of short-term market fluctuations, emphasizing the importance of having a clear vision and sticking to it. 3. In for the long haul. Embrace the power of compound interest. Rather than continuously trading, choose stocks with a vision to hold them indefinitely. As history shows, Buffett's long-term commitments to companies like Coca-Cola and Wells Fargo have yielded remarkable returns. One of Buffett's standout qualities is his ability to separate emotion from logic. The stock market is often driven by sentiments rather than hard facts. By keeping emotions at bay and focusing purely on the data and long-term trends, one can sidestep common investment pitfalls. Consistency in investment decisions, rather than reacting to short-lived market whims, can be the cornerstone of lasting wealth creation. In the world of investing, patience isn't just a virtue, it's often a predictor of success. 4. Learn and collaborate. Throughout his career, Buffett never hesitated to seek advice or collaborate with industry experts, be it his mentor Benjamin Graham or his longtime friend Charlie Munger. Their collective wisdom often paved the way for better investment choices. Follow suit and connect with trusted sources for invaluable insights. While the principle of holding onto stocks long-term is sound, it's also essential to diversify. Buffett's portfolio, while seemingly straightforward, is well diversified across various sectors. This strategy ensures that even if one industry faces a downturn, other investments can potentially offset the losses. Continuous learning and evolving your understanding of the market is pivotal. Surrounding oneself with knowledgeable peers or mentors can provide not just guidance but also different perspectives that refine one's investment approach. 5. Knowledge is power. Before diving into a stock, ensure you fully grasp the company's operations. Buffett's portfolio is a testament to this, with simple yet powerful entities like Apple, Coca-Cola, and Southwest Airlines. Always align your investments with what you understand and are passionate about. The investment world is constantly evolving. New industries emerge, technologies disrupt traditional sectors, and global events reshape markets. A hallmark of Buffett's career has been his commitment to continuous learning. Whether it's understanding the tech sector's intricacies or assessing the impact of global events, staying updated is crucial. To truly thrive in investing, one must adopt an insatiable curiosity and a relentless pursuit of knowledge. 6. Be contrary wisely. A famed Buffett principle is to be fearful when others are greedy and greedy when others are fearful. It's about understanding market emotions and acting contrary to the general sentiment, but with wisdom and research backing your choices. Before investing, Buffett often interacts with a company's management. He believes that understanding a company's leadership, their vision, ethos, and strategy can offer critical insights into its future prospects. After all, a company is only as good as the people leading it. Being a contrarian doesn't mean going against the tide blindly. It requires a profound understanding of the fundamentals and the conviction to stand by one's beliefs even when facing opposition. 7. Value over price. Price tags can be misleading. No matter how promising a stock appears, always evaluate its intrinsic value. It's the core of every wise investment decision. Just like you'd ponder if a luxury car is worth its price, ensure the stocks you pick offer more value than their current market price. In the investment world, there's often a rush to act, to buy, sell, or trade. However, sometimes the best action is inaction. Buffett's strategy frequently involves waiting for the right opportunity, even if it means sitting on cash for extended periods. Thus, patience combined with a deep understanding of a company's true worth ensures that you're not merely following the market, but making informed decisions that prioritize long-term value over short-term price fluctuations. In addition, there's one principle that Buffett holds dear, yet it's often overlooked: philanthropy. He believes in not just creating wealth but also giving back to society. Through his commitment to donate a significant portion of his wealth to charitable causes, he underscores the importance of responsibility that comes with wealth. As we conclude this exploration into Buffett's strategies, it's vital to remember that while these principles can guide us, every individual's financial situation and risk tolerance are unique. It's always wise to consult with financial professionals or trusted sources before making significant investment decisions. In the realm of investing, there's no one-size-fits-all answer. However, with the right information, guidance, and a sprinkle of patience, anyone can navigate the complex world of stocks and investments. Here at Market Matters Media, we aim to be our trusted partner in this journey. And as always, if you found value in this content, remember to give a thumbs up, subscribe, and join our community of informed investors. Together, let's demystify the world of investments and create a path to financial success.